very much, and a very good afternoon. I would have loved the previous session to continue. I was really enjoying, Srini, you did a great job, and Mr. Gupta, Shekhar Gupta, fantastic. What a great conversation. My presentation is going to be very boring, so it is not going to be as exciting as what we heard. I have a friend here called as Vikas. He requested me to come in here and deliver this presentation in about 20 minutes. What's happening with the Indian real estate? So you're going to see a lot of data. Much of it is proprietary, but I brought it because Vikas requested me if you can show some of these data. So much of it that you will see will be the first time that data is coming up. I have precisely 24 minutes, so I will make sure that this presentation gets over in 24 minutes. Clearly at this moment in time, the Indian real estate is in the newsroom doing an exceptional job. Every morning you wake up and there is a new high that has been created within the Indian real estate. Doing much better than the Nifty and the Sensex. If you look at the reality, both on the Nifty and on the BSE, doing much better in terms of the growth. I'm going to quickly cover the three sectors, which is office, retail, and residential. First is office. Office is actually a bad word. It is, I was reading over the weekend in the papers, and John Gray, who is the CEO of Blackstone and has about $1 trillion invested in the asset $1 trillion. He said their office exposure post-COVID has gone down to 2%. And that is all that Blackstone's exposure is at a global level. I had no idea. Yet in India, I'm going to make this statement, is that 2024 was the best year since independence that India has seen on the leasing side. It was just a phenomenal year. What we saw in terms of 50 million square feet of net leasing. What you see in the red is the net leasing. What you see in the green is the new completions that were done. The gross leasing was about 80 million square feet. Never ever. We've seen this kind of growth that has come up on the office leasing. So it did appear like, the stars, the sun, the moon, the earth, the truth, everything was very much aligned for the office sector. And it does appear that 2025 will be a similar year as 2024. Interestingly, Bangalore continues to lead. Nearly 1/3 of the overall leasing activity is in that market. That market is absolutely on fire. Million square feet, 1.5 million square feet, one occupier taking up spaces within that market. Interestingly, very interesting slide is American companies have taken more space on lease in India last year than the Indian corporates. So what you see in the blue is the American corporates. They have taken nearly 40% of the overall demand. Compared to that, India is 37%. Crazy that the American companies are taking more space in India than even the Indian companies. A lot of people think that it is only ITS, which is the purple that you're seeing at the bottom. But it is a healthy mixture of banking, financial services as the occupier class, consulting, manufacturing, e-commerce. Co-working is the yellow one. And you look at it, how the co-working has increased. So it is not only ITS. We do a lot of work for these global capability centers. And when you go in and meet up with the guys who are running it, they're not coming to India for cost arbitrage any longer. They're coming in for the talent. They are not being able to get in the quality of talent in the quantities that they want to recruit in their home countries, as a result of which they're coming into India and they're setting up their GCCs here. This is a slide, as I said, is, it's not very often that we put this slide. Is what it shows is in the green, the total stock that is there in that particular city. What you see in purple is the vacancy in that city, and what you see in orange is the new construction that is coming in. What worries me is definitely Hyderabad. amongst these all is, I do feel is there is a huge amount of overcapacity that is being built. There is nearly 27% vacancy, and with 37 million square feet under construction. Each year it's between 8 to 11 million square feet that is leased. So clearly there is a 4-year supply that is being constructed today in Hyderabad. So that is what worries me. What I really like on this slide is Bangalore and Pune, very solid, very nice two cities. Structurally, you should take into account that there will be a 10% vacancy across these markets. So they're really, really playing at an ideal level. On the retail, similar to what we saw in the office, a huge amount of demand, which is what you're seeing on the red bar there for 2024 calendar year, but very, very little supply that has come up in the organized retail side. This is the typology of the occupiers. So apparel is about 37%. What is increasing is F&B and entertainment. So the yellow and the red, those are the two bars that are increasing within the retail space. Interestingly, retail, a lot of people are very negative to say is that retail real estate is not an area that we would want to invest. What we decided is to actually divide it between grade A, B, and C malls. C malls are those where the developers have already sold them as strata. So they're no longer on the developer balance sheet. A is really where they've held it with themselves. It's like the Phoenix or the Nexus or the Rahejas or the Prestige or the DLFs. So they're the ones in blue. Look at the single-digit percentage vacancy. In NCR, there's 1% vacancy in that market is on the retail side. Similarly, Calcutta, you look at it, MMR, Pune, that's the blue one. So it is a great asset class to get in. You have to just make sure that you're able to divide between the grade A, B, and C malls. I've only covered 16% of the Indian real estate. 84% of the sector is residential. So this is the massive part of it is, it used to be wild, wild west before 2014. I used to run Jones Lang LaSalle in India. I would get in, many of the international guys, and they would say, look, how is this possible even that the government is not, intervening in what the developers are doing. So it was a case where, if I was the developers and you were the home buyer, you had to sort of pay me the installments on a monthly basis. I could do whatever I wanted to do with the money that I was receiving from you. If I wanted to buy a fancy car, I could buy a fancy car. If I wanted to buy an aeroplane, go on holidays, buy the next plot of land, nobody could stop me from doing that. There was no regulation. It was not a must that the money that you were paying me had to go into construction of that particular asset. So that is what it was, wild, wild west. And since 2016, regulation has come in, and now we are seeing renewed growth in this sector. Again, this is not a slide often that we put it up. Nearly 5.67 lakh crore new homes were sold in the calendar year 2024. So nearly 5.67 lakh new homes that were sold in these 7 tier 1 cities. But if you were to look at the green in terms of value, 41% is just MMR. So this city actually means a lot. 41% is just MMR. The balance India all put together is 60%. And in that is then NCR, which is at 16%, and Bangalore, which is at 14%. So MMR is very dominant in this. Two other data points that I'll give you is that compared to 2023, in terms of the annual increase in the sales volume, we went up by 16%. But in the number of units, we have dropped down by 6%. So 16% increase in the value, but 6% decrease in the number of units sold. So, it's the first time we're starting to see there is some slackness, some slowness now getting into the market, is because 2024 in terms of number of units sold was not as vibrant as 2023. So, we do feel is that as we go forward, and the stock market, if it continues to remain lackluster, certainly, at the luxury real estate or the premium or the ultra luxury, we are going to see some, slowness in that market happening. So it does get camouflaged in the news that, 16% increase from 2023 to 24. But as I said, is, if you peel the onion, actually the number of units in 2024 were lesser that were sold than 2023. This is a very sad slide. I was thinking, should I put it up or should I not put it up? But then I decided I'll put it up. Is what it shows is that the affordable housing is just going down as a percentage of the overall sales. So the yellow is the affordable housing. So 2019, if you were to look at it, 40% of the total sales were really affordable housing. And today it stands at nearly 16%. So which means is two things is either rich are becoming richer, and that's where you're seeing the luxury and ultra luxury. It has moved from 9% pre-COVID to nearly 31%. Or that the new supply is just not coming in the affordable housing. And when you're going to speak with the developers, some of them are in this room, they will say is that it is the latter. We're not being able to build affordable housing given where the land prices are, given where the premiums and the government approval costs are, given where the construction cost is. We're not being able to produce affordable housing as a result of it. It's less to do with the demand. It is more that the supply is just not coming up. And true to the developers, they're making a lot of money in the luxury and ultra luxury. As a result of which, you're seeing nearly 31% sales that are coming up in that sector. Sorry, supply that is coming up in this sector. Interesting slide is, we track this, throughout every financial year. What it shows is the affordability trend. So what it is the affordability ratio, which is the income loan divided by your income. So income loan payment, which is the EMI, divided by income in number of months. So the lesser the number of months, the more affordable it is. So if you were to look at it, FY24, we are at 38 months. At 2007, 2008, we were nearly coming up to 60 months. We are down to where 2010 was. So 38 months. So interestingly, whilst the prices have gone up, and that is what we hear, that the prices have gone up by nearly 56%, from the start of 2020 to 2024, 56% increase in the prices. But the story is that from 2013 to 2019, the price rise on residential was only 12% in 6 years. So actually, when you look at from 2013 to 2024, on an average, it's 5 to 6% increase in the residential sale price, which is why it is still making affordability at its lowest, because your income levels over this 10-11 year period has gone up faster than the property prices that have increased. If you were to only look at the abstract for 4 years, yes, it is true is that the income levels won't have gone up by 56%. But as I said, is the story has to be looked at it over a decade, that prior to that, the 6 years, there was only a 2% on an average increase in the residential prices, and that's where the affordability that you see. The inventory is at its lowest that we've seen. The overhang in the inventory is 14 months. Usually 18 months is where the equilibrium is. That 18 months inventory should really be there. This means is that the pendulum is in favor of the developers at 14 months. Interestingly, we're seeing is the sizes of the apartments going up. If you were to look at it from 2019 to now, nearly 34% increase in the size of the apartment. Used to be about 1,100 square feet. Now it's about 1,500 square feet. So from a developer's perspective, if you look at it, whilst the number of units may have gone down, three things are happening is, one, your price rise has happened. Second, the size of the apartment has gone up. And third, in terms of consolidation, the listed and the leading unlisted players are eating somebody else's lunch, as a result of which they are benefiting from the growth coming in with these three segments. This is the market share of the listed developers. So they're anywhere between 9% to 16% of the overall sales across India. Interesting slide. This is the sales booking versus the guidance that the developers had given. So in fact, at the start of January, majority of the developers had crossed 60% of the sales guidance for the year. So likely that they will be able to deliver on the guidance. The two developers who've not been able to come up there is Prestige and Shobha. Rest of them are all above 60%. So, we are hoping in this last quarter they will be able to come up to the guidance value. This is their launch pipeline, and this is heartening to note is that there is 253 million square feet. What they had publicly announced is the total launch of these top 10 developers. Out of the 253 million square feet, they've only launched 73 million square feet. So there's enough and more yet to be launched. So nearly 30% of it is launched. 70% they still have. So they still have a huge amount of raw material for them to be able to go proceed with it. Is not only that, 2024 was one of the highest land deal year. There was a huge amount of take-up of land. So whilst these developers, they have brought down their debt first, which is the greatest thing. The second is that they have gone ahead and continued to buy land so that there is a raw material that is in production. And third is, I meet up with them. Many of them are, friends. I can tell you with a little bit of alcohol in the body, truth starts to come out. And, they're absolutely clear. Anuj, if we sell even one apartment, we're going to make sure that we complete this development. Even if we have to go out and sell, our wife's jewelry. That is the mindset that the developers have gone into. It is that we have to, come what may, we have to deliver that project is, and which is really heartening, from the perspective of what we saw in NCR, with Amrapali and Supertech and Unitech and number of these guys. Two saying is that even if I have to sell my wife's jewelry, I will make sure that I deliver this entire project, and that is what you're now starting to see, the consolidation with the big guys. My last 3 or 4 slides, just on the private equity. The space remains as vibrant as what it was in FY 2024. Obviously, we are not unlikely to touch FY 2021, which was the best year ever because there were 2 very large transactions in excess of 10,000 crore each. One done by Brookfield, where they had acquired the income-generating assets of RMZ, and the other one by Blackstone, where they had acquired the malls and the office portfolio of Prestige at that time, and that's why you're seeing a huge amount of private equity on that. Our guess is that we will be about the same level as FY 24. In terms of the mix, in the investment, the 9-month, in the last financial year was a lot more dominated by offices. This 9-month period has been dominated by industrial. So there is a huge amount of demand on the industrial and warehousing by the private equity guys. The average ticket price has gone up. It is nearly $117 million, 32% increase from last year on an average. Just last 2 slides. This is a big sector, warehousing, and I do feel is that as investors, one should really look at it. It is becoming as vibrant as offices. This is where the Make in India is really playing out, where we are starting to see a lot of the manufacturing companies out of the US not shutting down their plant in China, but their 3rd or 4th plant, they're not wanting to build it in China. They're wanting to look at China plus one, and in which India is benefiting. So clearly on the manufacturing side, that is where it is. And on the e-commerce side, quick delivery is where we're starting to see a lot of the warehousing take up. This is also a space which is largely being operated by the private equity guys, 4 or 5 large private equity guys. They're the ones who are consolidating in this space. And the other sector that I would say is worth keeping in mind is this data center, where now, Srini, you've gone into this sector. This is again a very high consumption capital sector, but it is a sector where we will continue to see, because of government regulation, a huge amount of growth within the data center, and largely again run by the private equity developers starting to come in to this sector, but because it is so capital intensive that it is largely being played by the private equity. That's it. I have 2 minutes left. So.
Anuj, first of all, thank you so much for doing this, and thank you for being super fast to sort of, I ate up on some of your time. But the question that I had, and is, you put up a chart there where you talked about global captive centers and American corporations actually leasing more than domestic corporations. In this audience, we have many family offices and high net worth investors as well. And as you know, many of them buy office property directly. They typically buy maybe a floor or a part of a floor. Or there are propositions about investing in funds which may buy part of a property or a floor of the property. Can you just elaborate, and for the benefit of everybody, why do global funds only buy completed large office spaces as opposed to buying individual floors? Pros and cons of that for the benefit of my audience. Thank you.
I think it's a very interesting question that Srini asks, and I'm very much supportive of that view that why do global funds not do strata? They don't buy a floor, a single floor. They would tend to buy the full building themselves. I'll give you an example is in BKC. Many of you will be aware, I'm in a building called as 1 BKC. 1 BKC was done by the same developer who had capital. So capital is on one side, 1 BKC, both, fantastic building. The developer did a phenomenal job of that is. 1 BKC, a few years ago, we sold it to Blackstone, for example. Blackstone took it on. Their ability to continue to upgrade the common areas, their ability to form communities, their ability to bring in amenities, their ability to be able to bring in more F&B in there, because they own the entire block, to be able to ensure that the occupiers of that block were really serviced well, was far greater than when it came to capital, which was strata titled. If it is strata titled, I want to change the lobby. I'm unlikely to get 1,000 guys come together and pay me money for upliftment of the lobby, or if the car park needs to be repainted, unlikely that I will be able to do it. Or if I own the ground floor space, for example, I'll give you this example is in 1 BKC, we are getting occupier called as Bougie Cafe. You would know it. Now, Bougie Cafe is not paying the kind of rent that anybody else would have been able to pay it. But we know that that really enhances the experience of the occupier. Now, in capital, if Bougie Cafe was to go in and say, I want it at 50% the price, the occupier of that restaurant is going to say, I'm not going to give it to you. Why should I do charity for the rest of the building? That is where the dialogue then starts to change, is that if you have the full building, your ability to control the environment, your ability to control the narrative, your ability to continue to invest is far greater than if you were to own, one random floor in a building. And today, if you look at the rentals, rental at 1 BKC is anywhere between 410, which is where Kotak has signed, to 450 rupees versus, capital is anywhere between 325 to 350. They both started at the same level because one continued to innovate itself and modernize itself. That is where they have been able to go in. And that's what the private equity wants, that their ability then to be able to increase the rental. And then at some stage, the nature is private equity, they will flip it, whether they flip it into a REIT or whether they flip it to any one of you, sitting in this room it is going to be dependent on the rental yields at the time. And because they've been able to get up the rental yields, they're able to make capital values. That's the game. As one floor owner, Srini, you wouldn't have been able to do anything to that extent.
Thank you. The impact of Trump and Indian real estate per se, specifically residential, what do you see? Short-term impact and maybe a couple of years, 1 or 2 years further.
So Deepak bhai, less on the residential, and I'm not qualified to talk about on the office, but my fear is, Deepak bhai, if you see that slide, that on the occupier profile, if the country of origin is US, even greater than India, and Trump sees that slide, next morning he's going to wake up and he's going to say about tariff gaya baad mein, isko band karo pehle. So, that is what my worry is, that he's going to start to see is, this is the kind of job creation that is happening by the American corporates in India, more than actually Indian corporates are doing it. It's like, I hope he doesn't see that slide. Yeah, delete, exactly. On the resi side, I think, Deepak bhai, it is more connected with the stock market. Stock market can have vagaries of Trump in there but it is more sentimental that we see is if this market goes down, certainly we start to see is, people's shoulders, drooping, takes much longer for the buyer to do the deal, but less a Trump impact on the resi directly.